Hello and welcome. As I illustrated in my video on cash cost, the way a silver producer calculates cash cost is by adding together the total operating costs and credits, subtracting the revenue obtained from selling of the byproduct metals, and then dividing the remaining total cost by the number of silver ounces produced to get a cash cost per ounce. If you have not already done so, please watch my 3-part series on understanding the cost categories of silver production. The method of subtracting out byproduct credit that producers use to calculate out cash costs means that the cash cost of silver production is inversely proportional to the retail price of the byproduct metals. If metal prices rise overall, it means that producers sell the byproduct metals for more revenue and therefore get to subtract a larger amount off the cost of production, leaving a smaller remaining balance to be applied to silver. If metal prices decline overall, it means that producers sell the byproduct metals for less revenue, and therefore get to subtract a smaller amount off the cost of production, leaving a larger remaining balance to be applied to silver. Most primary silver producers obtain 20 to 50% of their revenue from the production of byproduct metals. Therefore, to gauge a real change in production costs, one has to look at both the rate of change of cash costs combined with the rate of change of the spot price of metals. The method of calculating out cash costs producers use presents some possible problems, as it can present what could be considered a misleading look at the production costs of producing silver. Let's look at a theoretical example to illustrate. Let's say that a producer produced the exact same quantity of metals each year and the total cost to produce remained constant. Let's also say that metal prices rose each year. Each year, the increase in metal prices would bring in more revenue from byproduct metals, which means that more would be subtracted from the total production costs. This means there would be less cost remaining each year to be applied to silver. Financial statements would show cash costs decreasing each year when actually the cash costs to produce were constant. Now let's look at silver cash costs in 2010. In 2010, the silver industry shows a cash cost decline of 2 cents from an average of 2009 of $5.29 to an average of 2010 of $5.27 per ounce. In reality, production costs increased during this time. However, metal prices also increased. Because metal prices were higher, the producers brought in more money from the gold, zinc, lead, copper, and other metals they produce. Silver producers were able to sell the byproduct metals for more revenue, which subtracted more off of the total production costs, leaving less cost to be applied to silver. This made it appear as if costs decreased when they actually increased. When metal prices drop like they have lately, it hurts a company's balance sheet. In addition to less overall revenue coming into the company, the cash costs increase as the amount of revenue from byproduct metals decrease. In other words, if metal prices remain lower, the byproduct metals producers sell will bring in less money. Less money will then be subtracted from the total production costs, leaving a larger percentage of the production cost to be applied to silver. Estimates for 2013 cash costs for silver producers are understated. The current prices of metals are much lower than the metal prices that producers use to estimate byproduct credits for 2013. For instance, most producers use an estimated price for gold revenue of $1,600 per ounce. If prices remain at current levels all year, it means that silver producers overestimated the amount of revenue that they will receive from the sale of byproduct metals, and therefore underestimated the remaining costs that must be applied to silver production. The effect that the overestimation of income from byproduct metals will vary from producer to producer, mostly based on the percentage of income that comes from byproduct production, and most primary silver producers obtain about 20 to 50% of their revenue from byproduct metals. When cash costs increase, it means that total and complete costs also increase. At the time of making this video, 2013 stated estimates for cash costs for some silver producers show that the decrease in revenue caused by the decline in metal prices pushes complete costs at some mines above the current spot price of silver. In future videos, I will be breaking down the major silver producers' costs producer by producer. See you then.